Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to our podcast. This is episode 127 of your Tax-Free Life podcast. So I'm excited to be here with all of you today. And a few days ago, I was having a conversation with one of my clients during a review, and he's someone that has been listening to my podcast since day one. So I thank every one of you that listen to my podcast on an ongoing basis. And he was telling me that, Bert, every single podcast that you do, you have the opportunity, and you speak quite often about taxes in the U.S. and where we're at today, where we're going to be in the future. But I think it would be a very good idea for you to do an entire podcast on taxation. So I'm taking him up on that. So Ralph, thanks so much for the feedback and the information. So I'm giving you credit. I'm not going to mention your last name, but Ralph is one of my best clients in the world, and I'm going to use his idea of talking a little bit about taxes today. And the name of this episode is The Economics of Taxation in America. So I want to break it up into three parts for all of us to kind of go through and be able to understand. One would be tax history in the U.S., and number two would be today's tax world in America. And then number three, which is the important one at the end of the day, is, the bottom line for taxation. And what are some of the things that all of us need to start thinking about and doing in order to avoid the, the nemesis of taxation at some point in time in the future. So let's get right into it. And I love to talk about taxes. As you know, I do a lot of accounting for clients, and I'm a tax planner. So I love to read about taxes, and I can tell you all kinds of stuff about taxes, but I'm just going to go with the basics because I think it's important that, if you're able to understand the basics and you know where we've come from, then you'll know where it is that we're going to go in the future from a taxable standpoint, and what would be the things that you need to do in order to protect yourself, your family, and your retirement assets from excess taxation by the U.S. government. So, going through a little bit of tax history in the United States, nothing is certain but death and taxes. And obviously you have heard that saying, for many, many years. And, it is very true that only death and taxes are for sure or certain in the United States. In the very beginning of our country, even before it was a country, the colonists were being imposed a tax by the British government. And the taxes would be on just about anything that the British government wanted to tax them on. So if you read anything about tax history in the U.S. Constitution, one major imposed tax was on tea, on the sale of tea in the United States. It wasn't even called the United States at that point in time. And then that brought about the famous Boston Tea Party. I grew up in Boston, so that's one of the areas that I had to study really hard in school. And then obviously if you do any tours in Boston, they'll take you where the Boston Tea Party at the harbor where it occurred and how it took place and so forth. So historically, the city of Boston has had a tremendous history in the United States and has had a tremendous impact since the very, very beginning. Now, the U.S. Constitution gave Congress the power to impose taxes on its citizens, and they did at different points in time. As a matter of fact, if you really think about it and you do any reading or studying of the Civil War, the Civil War was actually fought because of taxation without representation. So, there were other issues and slavery and so forth, but one of the primary issues was, taxation without representation. Now, the Civil War did something very, very interesting. It actually led to to the creation of the first tax system, but our system today was enacted actually in 1913. So there were a number of tax systems that were created right after the Civil War, but then in 1913, our system was actually created. And there was one major thing in our system. There's a great book that I read probably about 12 years ago, and it's called The Creature of Jekyll Island, which is one of the best books that I would recommend to any of you to read. Jekyll Island happens to be an island off the Carolina coast, and back in 1913, or just before that, at the end of 1912 and the beginning of 1913, some of the most prominent families in the United States, the wealthy families in the U.S., went to Jekyll Island, and that's where they created, the IRS and the IRS code. And then obviously the first tax system and the banking system, one of the top banking systems as we know today. So it's a great book to read. Once again, it's called The Creature from Jekyll, Jekyll Island. And then obviously the IRS was also created in 1913. Now, in 1913, the approved taxes on U.S. citizens could not exceed 7.5% of income. So I guess, as you can tell, we've come a very, very long way from that point in time. So it was actually legal to try to charge U.S. citizens anything above 7.5% of income taxes. So, that tells you how bad things have gotten and how quickly they have gotten to this level. So now that brings me to today. And I think it's important to understand where we're at today, because then we can figure out what the future is going to look like for all of us from a taxable standpoint. So today we're living under the TCJA, which is the Tax Cuts and Jobs Act that President Trump signed into law in December of 2017, which actually took effect January 1 of 2018, and that's a current tax law today. Now, that tax law that we're living through today will be sunsetting December 31st of 2025. So when we all wake up January 1 of 2026, we will be back to the old tax law prior to 2018, in which the standard deductions are going to be lower, the tax brackets are going to be higher, and obviously more and more Americans are going to have to itemize, or they're going to have to pay a much higher tax than what they're paying today. Now, I do a lot of tax planning for clients, and you'll hear a lot of people talking about the fact that the Tax Cuts and Jobs Act, all of those savings went to the wealthy. Well, I would disagree with all of that, because the vast majority of my clients that are either individuals, professionals, or business owners have actually benefited from the Tax Cuts and Jobs Act. And I would further state that, most Americans nowadays are not itemizing. They don't have to, because they have a very large standard deduction, and many of them don't even come close to meeting the standard deduction when it comes to paying taxes and taking, your deductions, exemptions, and credits along the way. Now, here's a fact for all of you to consider, because I always hear that, we need to increase taxes, and you hear this, and by the way, I'm not getting political, but I'm telling you where it's coming from. The vast majority of the liberal media and liberal politicians, always say that, we need to tax, we need to have the wealthy pay a higher tax because they need to be able to pay their fair share. Now, whenever I hear that statement, my question is, well, what's your definition of a fair share? Because for everyone, fair share may mean something totally different. But I'm going to give you the factual information based on the tax laws that we're living today, and the tax laws that we have been living for many years, because even under the old tax law, some of these numbers that I'm about to share with you did not change. So the top 1% of earners in the U.S. pay 40% of all federal income taxes. Now, that's more than what the bottom 90% pay combined. So let me repeat that again. The top 1% actually pay 40% of all the taxes, and that's more than what the bottom 90% pay combined. Now the top 20% pay 90% of all federal income taxes. The bottom 50% pay only 3% of federal income taxes. So there's a major disparity based on tax rates right there, as you can see. But then again, liberal politicians preach about increasing taxes so that the top 1%, pay their fair share. And once again, as I just said a few seconds ago, what's your definition of a fair share? And what if you were at the top 1%? The other thing that we need to realize is that many of these top 1%ers, or maybe of these on this top 20%, these are small business owners. These are not ultra wealthy individuals in the United States. These are mom and pops, and these are businesses where the business owners started from scratch. They've been working all of their lives, 70, 80 hours a week in order to make something better for themselves and their families, and they have created a business, and all of a sudden, they happen to be part of that 1% or part of that 20%, depending where you fall in that echelon of taxation from a business and taxable standpoint. Now, another thing that's important to note is that only about 50% of all taxes collected by the U.S. government actually come from federal income taxes. So about 1/3 of the taxes come from payroll taxes, which are primarily levied on working people and corporations. Now, in 2020, the taxable wage base is $137,700. So any income, any W-2 income that you generate under $137,700, you're going to have to pay Social Security and Medicare taxes on that money. So as you can tell, Medicare taxes, now just based on your payroll, take a look at your payroll. You pay out of pocket yourself, you pay a tax, Social Security, what they call FICA payroll taxes of 7.65%, of which 6.20% will be for Social Security, and you will pay that 6.20% up to the taxable wage base in 2020, which is $137,700. Once you pass that taxable wage base, you no longer pay FICA taxes, or you no longer pay that 6.20%. Now you will continue to pay the additional 1.45% that now makes up the entire 7.65%, and you will pay that 1.45% for Medicare, and those taxes are unlimited. So if you make $1 million, you will pay 1.45% on the entire $1 million. Now, when the employer, your employer, joins in on the tax, on the Social Security side of the house, it would be 6.2 for you and 6.2 for the employer, for a total of 12.4%. And then on the Medicare side, it would be 1.45 for you, 1.45 for your employer, for a total of 2.9% for Medicare. So it's not only the federal income taxes that all of us, all of you, and all of the wealthy in the top 1% are paying, and the top 20%, but it's also the additional Social Security and Medicare tax. Now, for those of you that may not know this, Social Security taxes, or the Social Security system, was implemented and basically enacted in 1935, and it increases every year. So that $137,700 today is going to be higher next year, and the year after that, and the year after that, because the government wants to capture more and more taxes out of your paycheck. And that's also very important for you to keep an eye on. Now, when you take a look at a wealthy individual, yeah, I would argue that a wealthy individual is going to pay proportionately a lower payroll tax than a regular employee. So, for instance, let me give you an example. If you're a nurse earning $50,000 a year in W-2 income, then obviously you're going to be paying that 7.65% on those entire $50,000. up to the taxable wage base of $137,700. Now, a millionaire investor, let's say with capital gains and dividends, will not pay payroll taxes, because payroll taxes are on earned income, on W-2 income, not on capital gains and or dividends. Now, let me give you another example. Let's say someone who's a basketball player making, $20 million a year. Well, they're only going to pay, even if that is all income, they're going to pay Social Security taxes up to, the taxable wage base, again, of $137,700. And then between that and the $20 million of income, they're not going to pay any Social Security taxes on that. They'll pay the 1.45% Medicare tax on the entire $20 million, but only up to $137,700 of the Social Security tax. So proportionally, that nurse is paying a higher tax than that basketball player and or that business owner that has no earned income whatsoever. But that's the way that the tax system is designed. Now, obviously, that wealthy individual that has capital gains and dividend taxes will have to pay capital gains taxes and also dividend income taxes along those lines. And then obviously for that basketball player who's making $20 million a year, they're going to have to pay a lot of money in federal income taxes as well. So that's important to note. Now, another tax that most people don't talk about is the estate tax. And by the way, the estate tax is also known as the redistribution of wealth tax. It's more like a communist tax if you think about it. Actually, it was first created in 1797, and the reason why the estate tax was actually created in 1797 was to be able to fund the beginning of the U.S. Navy. So that's something, and that was a good cause, and I'm glad that they did at that point in time. And by the way, the estate tax, has been changed 17 times since 1797. And there has been years where there has not been any estate tax whatsoever. Now, you also have something called a gift tax, and I'm not going to go into details into the gift tax, but if you're gifting money to someone in excess of the most that you're allowed under the law, which is $15,000, I believe, in 2020, then obviously you're going to have to pay a gift tax on that. And it could be taken from the Unified Credit Trust, but we're not going to get into that right now. We'll get into that in next week's podcast, so you can get a feel for that as well. But the gift tax actually came about in 1924. Sales tax, as a matter of fact, were first enacted in Virginia in 1921. And now every single state of the union has some kind of a sales tax. Some states have it higher than others, but every state has a sales tax that they need to deal with. So, when you think about most of the clients, when I talk about taxes, they're only thinking about federal income taxes, and they're not thinking about the impact of not only the federal income taxes, but all the other taxes that they need to deal with on an ongoing basis, and that's important for them to consider. Now, how about state and local taxes? So if you happen to be in a state that you'll pay state income tax, you may also be in a state where you're going to have to pay city income tax. Let's say if you live in Boston, or you live in New York, or you live in California. A lot of these states have very high state income taxes and city income taxes that citizens of those cities and residents of those cities are going to have to be paying an additional tax along those lines as well. Also, in addition to that, you have property taxes. You have sales taxes. You have AMT, which is the alternative minimum tax. So if you take too many deductions, the IRS has a way to get you back into the game and charge you for taxes. And AMT do not increase based on inflation, so more and more Americans are now susceptible to AMT taxes than ever before. Now, there's been a lot of writing, and I've done a lot of reading on the flat tax. And there have been people in Congress that have brought about the idea of kind of getting rid of all our taxes and just have one flat tax that you would pay. And in many ways, of all the reading that I have done, it may be more suitable for all Americans. But, politically speaking, I don't see that happening anytime soon. But we're living through very turbulent times when it comes to tax law. So we'll just have to sit and wait and see what's going to happen there. Now, as you all know, our tax system is progressive in nature. And basically what that means is that the more you make, the more you pay. Now, currently, if you think about it, we have the third lowest tax rate in American history, yet we have the highest debt that we have ever had in American history. So what would that tell you? What that would tell you that you better be able to prepare for taxes, because there's a very, very high probability, I would even argue almost a certainty, that taxes are going to be a lot higher in the very near future than they are today. Now, there are other taxes that are not called taxes, and what happens is, there are a lot of governmental industries, and there are governmental agencies and cities and counties and states that they want to continue to generate revenue. So there are taxes that are levied against everything that you do, but they don't call them taxes. They call them fees. They call them surcharges. So, for instance, one of the major taxes in our country is inflation. You don't think it is a tax, but it is, because inflation is not tax deductible. And every single year, your dollar is worth less. So if in 2020 you have $1 and inflation is at 3%, next year you will only be able to purchase 97 cents out of goods and services because you just lost 3% to taxation. And you can't take a tax deduction on inflation because it is not deducted, but it is actually a tax. So you better pay attention to taxation, to inflation, because inflation is taxation without representation. Now, what are some of the other fees and some charges that you may see that are actually taxes being imposed on you? Well, take a look at your telephone bill. Take a look at your cell phone bill. You're going to have so many fees inside of those cell phone bills that most of us just pay especially now since we do everything automated. Most of you don't pay attention to your cell phone bill or your telephone bill. Take a look at it, and anything that you see that is a fee or a surcharge, it is actually a tax. How about the taxes that you pay for alcohol and tobacco? That's a major tax that you pay. They call it a fee, but that's also a tax. How about gasoline? I know in California, over 67 cents out of every gallon of gasoline, that's actually a tax. How about occupational licenses? If you want to do business in a state or in a city that you live in, you're going to have to pay a fee to get an occupational license. And they call it a fee, but that's more than revenue. That's nothing more, nothing less than revenue to that city or to that state. So that is also a tax upon every single dollar that you earn. So when you really start thinking about all the taxes that you pay in this country, and if I were to say to you that anywhere between 45 and 55 cents out of every dollar that you earn goes to taxes, I'm not far from that number. Because when you factor in all of the taxes, fees, and surcharges that you pay, all of us are paying a tremendous amount of money in taxes. You just don't think about it because you're only thinking about the federal income tax rate. So you have to be able to start looking at your finances through a telescope as opposed to a microscope, because then you're going to be able to see a totally different view altogether. So now that I'm approaching the end of this podcast, what would be the bottom line? What would be the takeaway, for each and every one of you listening to this podcast today about, taxation in America? Well, you either have to adapt to change or you're going to become a victim of change. And what I mean for that is that you have to stay ahead of the ball. You got to know where the ball is going to be at all times and try to get there before the ball does. That's what Wayne Gretzky did in hockey. He always tried to, hitting skate and going toward the puck. He wanted to skate to where he thought the puck was going to be. So you have to be able either to adapt to change, or you would become a victim of change. You must also take a very proactive approach in managing taxation in your retirement accounts. And I say this often, but many of you don't take me up on it. Many of you continue to fund all of your retirement accounts. You leave the money in there. You may do a little bit of asset allocation here, asset allocation there, but you don't do anything else. And you have to do tax management, because if you don't do proper tax management, you're going to end up paying more in taxes than all the savings that you incurred while you were funding those accounts to begin with. Now, in a perfect world, you want your retirement accounts to compound, but you don't want your taxes to compound. So if I were to ask you, I said, would you rather have compound interest or simple interest? All of you are going to say, well, Bert, that's a stupid question. I want compound interest every single day of the week. But if I say, do you want compound tax or simple tax? You're going to say, oh, no, I want simple tax. As a matter of fact, in a perfect world, you want no tax. But just keeping it to this level here, you would want simple tax. The problem is that when you have compounding accounts, you're also compounding the tax. And when you compound the tax, especially on a tax-deferred account, not only are you compounding the tax, but you're also compounding the tax liability. So because of the fact that there's a certainty that taxes are going to be a lot higher in the future than they are today, then why are you playing that stupid game of allowing your taxes to be able to compound as well? Remember, while you're playing checkers with your money, the IRS is playing chess, and they know that game inside and out. And because of the fact that they can control all tax decision-making process in this country, guess who's going to win that game every single day of the week and every night, including Saturday? The IRS will, and the U.S. government will. So once again, you got to take a proactive approach in managing the taxation of your retirement accounts. You actually have the ability to compound the interest on that account, but then create simple tax. But for that, you're going to need to put together a tactical retirement blueprint, which is what I do for all of my clients as well. And obviously, that brings me to the point of having a tactical retirement blueprint, because many of you, although some of you have already engaged me in doing that, many of you listen to my podcast on an ongoing basis, and I know you mean well. I know that life gets in the way of time, and I'm going to call Bert next week, I'm going to shoot him an email and so forth. But weeks and months and years go by, and you're just sitting idling in your tax vehicle, not doing anything, and it continues to compound, and it's going to eat you alive at some point in time in the future. Because when you start to retire, and when taxes go up, then if all of your income coming in during retirement are all going to be taxable, then you're going to end up being at a much higher tax rate than you were before you started working, because during retirement you're going to lose a lot of the deductions, exemptions, and credits that you enjoyed while you were working and putting money away into your retirement account. So for those of you that want to pick my brain about taxation and or any other issues and concerns regarding retirement, please take me up on it. Feel free to give me a call. You can call me on area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, bertsalazar.com. And always remember that my goal for you and your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, stay safe, be good, and I'll talk to you again next week. Take care. Bye-bye.